Think of indemnification this way. When you sell your business, you're essentially making a series of promises to the buyer about the health and status of the company at the time of the sale. These promises are called representations and warranties. For example, you promise things like, all our taxes are paid up. We don't have any undisclosed lawsuits. Our financial statements are accurate. We own all our intellectual property. Indemnification is the clause that says, if any of those promises turn out to be false after the deal closes and the buyer suffers a financial loss because of it, then you, the seller, are obligated to compensate the buyer for that loss. It's essentially a post-closing guarantee you're providing. So, you're making all these promises or reps and warranties, but how can you, as the seller, protect yourself from things you don't know or things that are simply too minor to matter? This is where two powerful tools come in: knowledge qualifiers and materiality scrapes. On knowledge qualifiers. A knowledge qualifier limits your promise to only what you or a defined group of key people in your company actually knew or should have reasonably known after a reasonable inquiry. For example, instead of saying there are no environmental problems, which is a very broad promise, you'd qualify it to say, to the knowledge of the seller, there are no environmental problems. This prevents you from being liable for obscure issues you genuinely had no way of knowing about, protecting you from things buried deep in the past that even you, as the owner, might not have been aware of. It shifts the burden from an absolute guarantee to a good faith declaration. 2. Materiality scrapes. Many of your promises might include the word material. For instance, there are no material contracts that have been breached. This means small, insignificant breaches don't count. A materiality scrape then takes this concept a step further, especially when it comes to indemnification claims. Here's how it works. For calculating breaches, it often means that when determining if a rep has been breached at all, you ignore the word material. So, even a tiny breach counts as a breach for the purpose of triggering indemnification. For calculating losses, crucially for sellers, it means that when you calculate the amount of damages that go into the basket or towards the cap, you also ignore the word material. This sounds counterintuitive, right? Why would a seller want to ignore materiality? Because if the word material is left in for calculating losses, buyers could argue that every small problem, when aggregated, is material, bypassing your basket or cap more easily. By scraping materiality out when calculating losses, it ensures that only truly significant actual dollar losses contribute to the basket and cap thresholds, giving you better protection against stacking up small claims. Both knowledge qualifiers and materiality scrapes are sophisticated tools that your legal team will focus on to narrow your potential liability as a seller. They ensure you're only on the hook for what you reasonably knew and for genuinely significant financial impacts. Now, the good news is you're not writing a blank check forever. Purchase agreements usually include 3 crucial mechanisms to limit your exposure. 1. The basket. Imagine this as an insurance deductible. The buyer can't come after you for every tiny, minor issue. There's a threshold or basket that the total amount of their losses must reach before you have to pay anything. For example, if the basket is $50,000 and the buyer finds a $10,000 problem, you owe nothing. If they find $60,000 worth of problems, you'd only be liable for the amount above the basket, which is $10,000 in this scenario. It protects you from nuisance claims. 2. The survival period. This is your time limit. Most of your promises don't last forever. They survive for a specific period after closing, typically 12 to 24 months. Once that survival period expires, the buyer generally can't make any more claims against you for breaches of those particular promises. It gives you an end date for most of your liability. 3. The cap. This is perhaps the most important protection for you. The cap sets the absolute maximum dollar amount you will ever have to pay out for indemnification claims. Even if the buyer's losses are enormous, if your cap is, say, 15% of the purchase price, you will never pay more than that 15%. This gives you certainty about your worst-case financial exposure. If a claim does arise, how does the buyer actually get paid? 1. The escrow account. It's very common for a portion of your sale proceeds to be held back in a neutral third-party escrow account for the duration of the survival period. If there's a valid indemnification claim, the funds come directly from this escrow. It acts as a ready pool of money for the buyer and gives you, the seller, a clear understanding of where the money would come from. Whatever is left in the escrow after the survival period is released to you. 2. Direct recovery. If there's no escrow, or if claims exceed the escrow amount, the buyer can come directly after you for the funds. This is where your cap becomes even more vital, as it limits how much they can demand from your personal assets. Now, there's a crucial caveat. Not all promises are treated equally. There's a special category called fundamental representations. These are the bedrock promises that are so fundamental to the deal, they often have no cap. Your liability might be for 100% of the purchase price, or even unlimited for these specific breaches. Longer, indefinite survival periods. They might last for many years, or even in perpetuity. What are these fundamental reps? Typically, organization and standing, that your company legally exists, authority and enforceability, that you legally have the right to sell the business, ownership of shares assets, that you actually own what you're selling, no brokers, finders fees, that there aren't hidden fees owed to intermediaries, capitalization, that your company's ownership structure is exactly as you've stated, taxes, that your tax filings are accurate and complete. Buyers want maximum protection here because if these core facts are wrong, the entire deal unravels. So, indemnification is your post-sale promise to the buyer. But remember, you can control your exposure through negotiating a basket to filter small claims, setting a survival period for most promises, establishing a clear cap on your maximum liability, narrow liability using both knowledge qualifiers and materiality scrapes, understanding the specific implications of fundamental representations. Don't let this section intimidate you. With good legal counsel, you can negotiate fair terms that protect your hard-earned sale proceeds.